Hello, everybody. Welcome to my new YouTube channel, the Bearish but Paid Income Strategy. Here, we're going to talk about how to build a 30% per year yield from a portfolio that can survive bear markets and corrections. About me, I'm Mark Jolliker. I'm 56 years old, and I've been in IT for most of my life, still working. I've been investing on my own since 1999. I generally do macro investing. Rather than picking individual stocks, I look for major trends, secular trends, and things like that to get into. I also invest in real estate and have a few rental properties that throw off some income. And I'm a few years away from early retirement. With this channel, I hope to chronicle our strategy for generating income that we'll be pivoting to as we get closer and closer to retirement. We're going to want to use income to take some money out of the markets. Disclaimer. So this video is for educational and entertainment purposes only. I'm not a financial advisor. I'm not licensed in anything like this. None of this content should be construed as financial advice. Do your own research and consult your licensed financial advisor before making any investment decisions, including buying or selling the securities that we'll be talking about on this channel. So why income investing? This is really a pivot for me in the last several years. I've been buying and selling securities based on long-term trends, and the income. So our traditional emphasis is to seek, capital appreciation, but it's always tough to decide when to sell and when to buy. So when there are major downturns in bear markets, and I've lived through the 2000 dot-com bubble burst, the major great financial crisis in 15 years ago, and then again during the COVID-19 drop. All of these were tricky times when investors are fearful and are having trouble to decide, should they buy more of their favorite stocks, should they sell, and often people will make emotional decisions. The idea of income investing is that it focuses more on the income that you're getting every month. And because you're getting that income in as a paycheck, you can decide what to do with that money. Either you'll need it to to pay your bills, or you can reinvest it and dollar cost average back into those securities. Also, some high yield assets that I'm going to demonstrate on this channel: CEFs, BDCs, CLOs, preferred stocks. They all generate steady distributions even while markets are going down, and I'll be demonstrating how that is the case. And therefore, these are kind of uncorrelated assets, and they're uncorrelated to the major stock indices. While income investing, you can reinvest the distributions you accumulate to accumulate new shares, and often at a nice discount. This helps compound the growth of the income itself. And especially during early retirement or when you are living off of your portfolio of accumulated savings, the sequence of returns risk is a real emotional stressor during the first few years of retirement. And often people will not spend as much, or they'll tighten the belt when they have no income coming in to replace the money they're taking out of the market. So this style of investing, income investing, allows you to spend your money and keep most of your principal in the account. This approach is agnostic to market direction, so downturns become opportunities to reinvest. And I'm also going to show how we can, mitigate the risks of downturns with this channel. And income investors are trained to embrace volatility rather than fear it, because it helps grow your income faster. So why a bearish tilt? And I've been doing investing for many, many years. I'm quite a bit bearish right now for how the overall macro trends are, and there's several risks on the horizon. The market doesn't seem to be worried about these risks for the most part. We're at all-time highs, but there is definitely some risk that things will pop in the next few months or few years. So our valuations are at historically elevated at 22 PE, forward PE. Not much cushion and we've seen it in the earnings releases the last few weeks here, where stocks are getting hammered after giving positive guidance on their future earnings. So the market's getting tired of predicting higher and higher earnings into the future. So that's a risk of just high historical valuations. Wall Street, because of this, is starting to warn of a potential correction. This could be within the next couple of months or the next 2 years, but we will get pullbacks. Probably the next pullback will be a buyable dip and not a major bear market. But still, we need to be able to navigate through those 10 or 20% pullbacks going forward. There's policy uncertainty, tariff risk, overall geopolitical changes that could become a black swan to spook the markets. Also, the tariffs and rejiggering all of our supply chains may require companies to change tactics, change supply chains, and even tighten the belt. So they may disrupt the economy by throwing people on the job market. There's a bubble-like sentiment in AI, especially, and other tech areas. So this looks a lot like late 90s when the dot-com era, we had stocks with crazy valuations. So I don't know if we're at the peak yet or near the peak, but it definitely feels very similar. Earnings growth may be peaking. We're currently forecasting earnings growth for next year of 14%. At what point do those forecasts continue growing past this? In 2026, 2027, at some point we will have some kind of an earnings peak out. Global instability, global tensions, debt levels, and you've seen a few hiccups recently in the UK and in the US where interest rates have spiked due to some uncertainty around policy. And this is definitely a risk that when interest rates spike because investors are not happy to buy the debt, there will be some repercussions of that, and the stock markets will correct. And then we have inflation that is on its way down right now, and it's looking like it's slowly trending down, but it could reignite. And if it reaccelerates while the Fed is still in a tight stance, this could make again, a big surprise for the markets. And we have extreme market concentration, and this is really the passive players buying stocks with their 401ks, every paycheck, and this passive flows of money coming in have made the mega caps the biggest concentration, or the biggest part of the overall S&P and the NASDAQ 100. So pretty much every dollar going into the main indexes are actually about 40 cents or 50 cents of it is going into the seven magnificent seven stocks. So if these seven stocks start having a correction, they will take the entire market down, and that will have an impact again, with kind of a reflexive loop of those other companies having to do layoffs because their stocks are down, and that could actually start a bit of a recession as well. So why did I decide to do this podcast? Well, we have several great presenters on YouTube. I'm big fans of their YouTube channels that talk about FIRE, retire early, and PII, passive income investing. A lot of them are using covered called ETFs. They are making great returns, and I'm going to demonstrate how I'm doing that in my account as well. But there's not a lot of talk about the risks of what happens during a bear market like we had in the 2007. What happens when there's a bear market like we had in 2001, um, how will the income be affected? How will the asset value or the NAV be affected by these funds? So it's pretty significant risk, and I think that we can do better. Um, so I'm hoping that I can offer the community some ideas to improve your results. All right, so our strategy, what's the strategy? So I've got this diagram here to describe the strategy. Basically, there's four quadrants of my portfolio, and I'll start with the top left side here. These are all funds that are based on credit or debt payments. So it's really a core holding. It's safer than equities, but has equity-like returns. So a quarter of our portfolio is in that. We have, and I'll just click through the different categories here. We have some senior loans, and there's a couple of closed-end funds here that invest in senior loans. We have CLOs, and you can see here the estimated yield for each fund. Emerging market debt, this is a pretty interesting category, using debt from governments around the world that are outside the US. High yield bonds, again, some closed-end funds here that you can often buy at a discount and get a little bit better yield than just buying an ETF. And then we're using funds of funds or closed-end fund aggregators and other ETFs in here. So you can see the estimated yield. We will be digging into a lot of these funds as we go forward each week on this channel. So that was the first category, fixed income. So every month when we get new income from our investments and also from extra paychecks, I will throw more money into this portfolio, and I'll be buying based on an allocation percent, but always looking to buy into the fixed income at about 25% of the portfolio. The second part of the strategy is equity, the equity sleeve on the right here. And here, again, these are closed-end funds where we get to purchase at the discount to NAV often. And we also choose these funds because they have low NAV erosion. And I'll be analyzing these with you going forward to show how in previous downturns they did not have very serious erosion here. Also chosen because they have a low correlation to S&P, and really relying on the managers of these funds to be smarter than me for stock picking, and we'll let them do the hard work of deciding which stocks to go with. We also have some dividend ETFs, which are more or less value stocks. So here you could see some of the equity funds, USA. We have some preferred stock ETFs and CEFs. Some mortgage REITs and mortgage-related investments. Utilities and infrastructure, they pay a good yield. MLPs, similar to utilities. And a couple of super dividend ETFs that have a high dividend yield. All right, the third quadrant of our strategy is the high yield quadrant. And this is really where we have a lot of fun talking about covered call ETFs and BDCs. BDCs are like banks. They make money by borrowing at a low interest rate, and then they can fund a loan and get income at a higher interest rate. Right now, BDCs have been hammered due to some fears, of potential higher rates of loans going bad, and that's a recent thing. That has put BDCs in a great discount at the moment. So it's a good time to start looking at BDCs again. And our covered call funds make income by selling calls, selling options, and these are mostly based on S&P and NASDAQ 100. But I'm going to put in our mix here multiple different types of covered call funds that provide some differentiation or diversification. We don't want to be all in S&P and QQQ. So you can see here some of the covered call funds that we're going to be investing in. And we'll be showcasing some of these in the weeks forward. All right. Fourth quadrant of our strategy is the ultra high yield or risky yielders. These are the ones that will pay way more than 20% income yield or distribution yield per year. And it helps us juice up the overall portfolio to a 30% per year, target yield. Of course, these are riskier funds. They have a larger risk of corrections eroding the NAV. Also, these are based on high-flying stocks a lot of times, and therefore, when those stocks that I mentioned at the beginning start having their corrections, these funds will also correct very, very quickly. Here you can see a series of high-yield funds that I like. Misty GDXY is a high yield strategy on the gold miners. So that's a little bit of diversification there. Maxi is based on Bitcoin. USOY is based on oil futures, again for diversification. WPay, SVOL is not a covered call fund, but it has some tail hedge. It buys some puts on the S&P, and also it harvests the volatility contango yield. So it's really something different and works differently from the covered calls. And we have some 0-day DTE call options selling, and then we have FEET, which is a looking at 5 top ETFs from the YieldMax family. And it's momentum based and rotates through each month to the top 5 ETFs. So this will catch trends, and ideally will keep us in the hot stocks, basically the hot covered call ETFs, and allow us to drop out of those on a monthly basis once they've turned. All right, and the fifth bucket is bearish tactical funds. So those are funds that are used very tactically. So in other words, we'll go in and out of these funds based on changes in market structure and to provide some offsetting value when there's a correction in the high yielders. So for example, there's a tail fund, TAIL, that provides S&P puts to offset corrections and crashes in the S&P. And I'll be showcasing some of these in the coming weeks, and we'll dig down a little bit deeper on how these work. As part of our strategy, we have buying rules and selling rules. So, and the buying rules are that we'll buy a fund when we're under allocated versus the target allocation. So we want to buy more. Also, when the fund is at a discount to NAV, if it's a CEF, or it's in a downturn in general. So this chart shows an example of AMLP, a fund we really like. It's currently in a downtrend, and the trend has recently reversed up. So this is the buy signal to tell us when to initiate positions, turn on the drip if that's what you want to do to increase the holdings, or buy new or partial positions. You can see a couple of buy signals here in the last year, where I've got this little momentum indicator that I built that will switch from red to green when is the right time to kind of jump back in. It's not always accurate. It's not a perfect indicator, but it gives you a nice visual for when the trend has reversed, and it's pretty obvious here the trend has reversed in the last couple of weeks. Selling rules. So when do we sell? Well, we sell when we're over allocated versus our target allocation, and when we're near 52-week highs. That's the right time to consider selling. Sell your winners, and maybe you don't need to sell the whole account because you want to keep that position, but you may want to sell a portion, a few shares of that allocation to get back to your target allocation. And when to sell when you're near 52-week highs, not just when you're at the highs, but when you've seen the correction or a change in trend. So for example, JEPQ, here you can see that right now we are at a turning point where we were at 52-week highs and we have now dropped. And this is giving a sell signal. So if you're overweight on these types of NASDAQ-based stocks or covered call ETFs, feel free to take some profits. You can also see that it doesn't work all the time. So here in the middle of the year, we had some very short corrections that were immediately bought on dip. So that could be what's happening today or this week, but yet to be determined. The idea is you might as well take your profits when you're near the tops, so that if we start into a bear market, we will sidestep most of the bear market by watching the indicators here. All right, so that is the overall strategy. I will move into just giving you a view of the portfolio. This is more for a teaser for future. In the future weeks, we will walk through the portfolio in detail, and we'll let you ask questions and help explain why we have certain elements in our portfolio. So the first table at the top is the debt-based income. Again, these are all the funds I'm currently invested in. There are certain funds that are on the wish list or the watch list here that have no allocations yet, but they're currently not in a buying signal. So we are waiting to buy those. So RIV, PDI, CRF, CLM. We will edge into these as needed. I do have a target allocation of 2% for each fund, and I'm planning to use 50 funds in the total portfolio. And you can see here the current allocations of the current positions. Many of them are lower than our target, but again, I'm waiting for the buying signal to increase the allocations there. You can also see here there's certain funds that are in a drawdown from where we purchased them. And so this is something to manage as well, is to look for, okay, are these funds safe during different seasons? Are these the funds that will correct hard when we have a bear market? For the equity sleeve, we have another group of funds here. I guess at this point, nothing much to say here. Most of these have done really well and are not in a drawdown, and we're not losing money on them from a capital perspective. You can also see on the far right the yield percentage that is calculated based on the last distribution. So some nice high ones and a lot of average ones. Third sleeve is the high yield sleeve using the BDCs and covered calls. Again, you can see here there's a few that we're planning to buy back into, specifically the BDCs. FSK is a closed-end fund, and PBDC. I'm just waiting until this week. I'll be buying probably some new positions here. For tail, Tail is one of the bearish funds that I've added to this sleeve, and that is specifically because I'm feeling the markets are toppy and there's a risk of a longer downturn or a severe correction. So Tail again is will hedge out some of the risk by buying puts, and therefore when the markets go down and the rest of the funds start dropping, the puts will help us buy back in at a lower cost. Tail does not give a large distribution, about 5%, because most of its holdings are government treasuries. And the ultra high yield sleeve, you can see here we do have one position in one of the bears, that is winter. And in my next video, I'll be describing winter and how that works. I also have several of the other crash-related funds that are in buying signals, and we may be looking at those to add to the position fairly soon. So right now I've got about $120,000 position in total portfolio here, and its projected yield will be about $35,000 per year. So we will dig into that in the next video as well. All right, so thank you. Our next video will be bearish income on winter. We'll talk about the market regimes. Are we on correction watch? Is the current correction easing or getting more risky? We'll do a fun deep dive on WNTR, and then I'll give you a portfolio review and reviewing the income from our portfolio. If you like this video, please help me. This is a brand new channel. It's my first time doing a YouTube channel, so please help by leaving comments. Give me some feedback, positive or negative. Feel free. Also, please subscribe to the channel for the next to get the next video, and share it to anybody who's following income strategies. All right, thanks a lot, and we'll see you on the next video.